Hey traders, in this video, I'm breaking down order blocks, showing you how they work and how to maximize profits. Whether you're a newbie or a seasoned pro, this is your guide to trading smarter. What is an order block? An order block is a key zone on the chart where massive trading volume piles up. Big players like banks or funds use these zones to jump into the market. They might defend these levels or absorb them to lock in profits. When the price rockets out of a specific area, it signals a major order. Bullish order blocks form from buying pressure, bearish ones from selling. Order blocks often get retested, the price comes back to the zone and bounces. For example, if you short a bearish order block, you can score profits, but sometimes the price smashes through the block, breaking the market structure and leading to losses. Not every sharp move is an order block. A spike from news, for instance, doesn't count. Here are 3 golden rules. Rule number 1, imbalance. An order block must create a gap, or imbalance, between candles. If there's a space between the high wick of the first candle and the low wick of the third, that's an imbalance. To draw the block, stretch a rectangle from the high wick to the low wick of the first candle, covering the zone before the gap. Rule number 2, untouched block. Order blocks are one and done. If the price touches the block, even with a wick, it's invalid. For example, you spot an imbalance and draw a block, but if the price grazes it, ditch that block. Rule number 3, break of structure or change of character. The most critical rule, an order block must trigger a break of structure or a shift in market character. For example, on the daily Ethereum chart, we see a strong upward surge creating a gap. Keep that potential order block in mind, but wait for the market to confirm a break of structure. Once that happens, you can draw the order block with confidence. Which order blocks should you avoid? Blocks without an imbalance, it's just a sharp move doesn't cut it. Blocks already tested, they lose their juice. Blocks without a break of structure or change in character, as these are fake zones. Now, let's dive into a few strategies to take your trading to the next level. Strategy number 1, multi-time frame confirmation. Start by hunting for an order block on a higher time frame. Look for a zone with an imbalance and a break of structure. Wait for the price to return to that block. Then, zoom into a lower time frame and search for momentum signs like bullish or bearish candle patterns, indicators like RSI or MACD, or a break of structure. For example, on the hourly Ethereum chart, a bearish order block lines up with a bearish RSI divergence. It's a sell signal. Set your stop loss above the block and aim for a take profit twice the size of your stop. Why you waste time trying to grow a small account? With HashHedge, you can trade with real capital up to $100,000. It's simple, take the challenge, prove your trading skills, and get funded for real. Keep up to 90% of the profits. You don't need bigger profits, you need bigger capital. All the details are in the description below. Strategy number 2, inducement traps. An inducement trap is a setup where a secondary key level forms near a major order block. For example, you've got a major order block and a secondary level above it. After multiple rejections, this secondary level becomes an inducement. The strategy is called an inducement trap because the price often breaks this secondary level to retest the main order block. So, if you spot a secondary level above the main order block, that main block could be a killer entry point for a buy. This works because traders place stop losses just below key levels, and when those stops get triggered, it can spark a bigger correction. Now, let's look at a real example. On the chart, the price bounces off a range multiple times, then breaks structure, creating an imbalance. After an upward move, we identify an inducement zone since the price rejected that support level several times. With both a main and secondary order block in place, this sets up a potential inducement trap. Once the price breaks the secondary level and retests the main block, you can jump into a trade. Set your stop loss just below the order block and aim for a take profit 3 to 4 times larger. You could also target the inducement zone as your main profit goal. In this case, the risk to reward ratio could hit nearly 1 to 9. As you've probably noticed, the price bounces between these levels multiple times, proving just how powerful and effective order blocks are. Strategy number 3, breaker blocks. Order blocks can also shine after a breakout. A breaker block is an order block the price breaks through but later returns to as support or resistance. On the chart, a bullish order block forms with an imbalance, gets tested right away, and shows a break of structure. The price eventually breaks below it, creating a full change of character with lower lows. When the price returns to the block, it acts as resistance, as a sell signal. Set your stop loss above the block and aim for a take profit 3 times larger. Like regular blocks, breaker blocks are one-time use only. Order blocks are a heavy-hitting tool for trading with smart money. They reveal where big players enter the market, work with imbalances and breaks of structure, deliver big profits when used correctly. If this video helped you level up, smash that like button and subscribe. Drop a comment below and let me know which strategy you want to dive deeper into. See you in the next video.